Hey there, future Wall Street Titans. Let's talk about the biggest mistake newbie investors make. You know, the one chasing the next big thing. We've all been there. You see a stock skyrocketing, everyone's talking about it, and you think, I gotta get in on that action. But hold your horses. This FOMO, this fear of missing out, can lead to some serious financial wipeouts. Remember, what goes up fast can crash even faster. Chasing trends is like trying to time the market. And let me tell you, timing the market is a fool's game. Even seasoned pros get burned. So what's a savvy investor to do? Let's dive into a smarter strategy. Instead of chasing the latest fad, why not invest in something a bit more reliable? I'm talking about the backbone of our financial system, the economy itself. Think about it. When businesses thrive, so do their investors. It's a win-win situation. So how do you get in on this action? By investing in diversified, established companies. These are the tried and true players in the game, the ones with a proven track record of success. Think blue-chip companies, industry leaders, the big dogs. They've weathered economic storms before and come out stronger. Investing in them is like riding a powerful wave. It might have its ups and downs, but the overall trajectory is upwards. But how does this whole economy thing actually work? Let's break it down. Here's the deal. Our economy is a giant merry-go-round of spending and earning. Picture it like an amusement park ride, constantly in motion, with everyone playing a part. Consumers, that's you and me, buy goods and services from businesses. We spend our money on everything from groceries to gadgets, fueling the economy. Businesses take that money, reinvest it, and hopefully make a profit. They use these profits to grow, innovate, and provide more goods and services. Now here's where it gets interesting. Most people spend their hard-earned cash right back into the system. This continuous cycle keeps the economy vibrant and dynamic. They buy more stuff, perpetuating the cycle of consumerism. It's a never-ending loop of earning and spending. But here's the secret. Real wealth isn't built by simply earning a paycheck. Just working for money isn't enough to secure financial freedom. It's built by owning assets. Assets are the key to unlocking long-term financial stability and growth. Assets are things that put money in your pocket, like stocks, real estate, or businesses. These investments generate income and appreciate over time. They work for you, generating income and growing your wealth over time. The more assets you own, the more your wealth can grow exponentially. So how do you escape the consumerism trap and start building real wealth? The answer lies in changing your mindset and habits. You guessed it, investing. By putting your money into assets that grow, you can break free from the cycle of consumerism. But there's another villain lurking in the shadows that can erode your hard-earned gains: inflation. Understanding and mitigating inflation is crucial to preserving your wealth. Inflation is like that sneaky friend who eats all your snacks. It slowly but surely eats away at the value of your money. What you could buy for $1 yesterday might cost you $1.10 today. For folks living paycheck to paycheck, inflation can be a real buzzkill. Their expenses go up, but their income doesn't keep pace. But here's the kicker. Asset owners can actually benefit from inflation. Remember how we talked about assets? Well, they tend to increase in value during inflationary periods. So while your dollar might buy you less at the grocery store, your investments could be growing in value, outpacing the rate of inflation. That's the power of owning assets. But how do you choose the right assets to invest in? Let's dive into the exciting world of the stock market. Planting seeds of prosperity. The power of long-term investing. The stock market can seem like a scary, unpredictable beast. The constant ups and downs, the news headlines, and the sheer volume of information can be overwhelming. But trust me, it's not as intimidating as it looks. With the right approach and mindset, you can navigate it successfully. Think of the stock market as a garden. Just like a garden, it requires patience, care, and time. You plant seeds, which are your investments, and you need to nurture them. Nurture them by holding for the long term, allowing them to grow and mature. Over time, you'll see them grow through the power of compound returns, which can be incredibly rewarding. Now, some folks might be tempted to pick individual stocks, hoping to strike it rich. They dream of finding the next Amazon or Apple, the next big thing that will skyrocket in value. But let me tell you, that's like trying to pick the winning lottery ticket. It's a gamble, and the odds are not in your favor. It's incredibly risky and difficult to do consistently. The market is unpredictable, and even experts get it wrong. So what's a better approach? Diversification. By spreading your investments, you reduce risk. Don't put all your eggs in one basket. Diversify across different assets. Spread your investments across different companies, industries, and even geographical regions. Diversify across sectors and asset classes to balance your portfolio. And remember, investing is a marathon, not a sprint. It's about long-term growth. Be patient, stay the course, and don't get swayed by short-term market fluctuations. Let the power of compounding work its magic, and over time you'll see your investments flourish. Look, I get it. Picking individual stocks can be tempting. You hear about some hot new company and you think, this is it. This is my ticket to riches. But hold on a minute. Picking individual stocks is like trying to predict the future. It's incredibly difficult, even for seasoned professionals. You need to research the company, understand their financials, analyze their competitors, and even then, there's no guarantee of success. Remember, even seemingly invincible companies can stumble. Remember Blockbuster, Sears? They were once giants, now they're cautionary tales. The stock market is littered with the wreckage of once promising companies. So if picking individual stocks is so risky, what's a safer alternative? Let me introduce you to the wonderful world of index funds and ETFs. Index funds and ETFs are like the autopilot of the investing world. They offer a hands-off approach that can be incredibly appealing, especially for those who may not have the time or expertise to manage individual stocks. They take the guesswork out of investing and put your money to work in a diversified, low-cost way. By spreading your investments across a wide array of assets, they help mitigate risk and provide a more stable return over time. Think of them as baskets of stocks. Each basket contains a variety of different companies, so you're not putting all your eggs in one basket. This diversification is key to reducing risk. When you buy an index fund or ETF, you're buying a tiny piece of all the companies in that fund. This means you own a small part of many different businesses, which can be a safer bet than investing in a single company. This spreads your risk and gives you exposure to a wide range of industries and sectors. Whether it's technology, healthcare, or consumer goods, you're covered. There are tons of index funds and ETFs out there, each with its own investment objective. Some focus on specific sectors, while others aim to replicate the performance of a broader market index. You can find funds that track the S&P 500, the Dow Jones Industrial Average, or even specific sectors like technology or healthcare. Some popular examples include VTI. This ETF tracks the entire U.S. stock market, giving you broad exposure to thousands of companies. It's a great option for those looking to invest in the overall growth of the U.S. economy. SPY, the granddaddy of ETFs, SPY tracks the S&P 500, which represents the 500 largest publicly traded companies in the U.S. It's a solid choice for those who want to invest in well-established companies. QQQ. This ETF focuses on the tech-heavy NASDAQ 100 index, perfect for investors looking for growth opportunities. If you're bullish on technology and innovation, QQQ might be the right fit for you. The best part? Index funds and ETFs typically have very low fees, meaning more of your money stays invested and working for you. Over time, these savings can add up, making a significant difference in your investment returns. Additionally, these funds are designed for long-term growth. By holding onto them for an extended period, you can take advantage of the power of compounding, where your investment earnings generate even more earnings. Embracing index funds and ETFs is a smart move for anyone looking to build wealth over time without the stress of constant market monitoring. It's a strategy that aligns well with a passive investing approach, allowing you to focus on other important aspects of your life while your investments grow. Here's a little secret. You don't need to be a Wall Street whiz kid to be a successful investor. The key is consistency. It's like working out. You don't get ripped by going to the gym once. You get results by showing up consistently, week after week, month after month. The same goes for investing. Set up a system for regular automated investments. Whether it's weekly, bi-weekly, or monthly, the key is to make investing a habit. Think of it like paying yourself first. Before you spend money on anything else, put a portion of your income towards your investments. This disciplined approach will not only help you build wealth over time, but also prevent you from making emotional investment decisions. Remember, slow and steady wins the race. Imagine this. You put all your money into a single stock. It's a company you believe in, a surefire winner. But then, disaster strikes. The company's earnings disappoint, a scandal erupts, or a competitor emerges. The stock plummets, and you're left holding the bag. That's why diversification is crucial. It's like having a financial safety net. By spreading your investments across different asset classes, sectors, and geographies, you're mitigating your risk. Don't put all your eggs in one basket. Instead, create a diversified portfolio that can weather market storms and deliver consistent returns over time. Remember, investing doesn't have to be complicated. By following these simple principles, you can set yourself up for financial success and achieve your financial goals.